Welcome back, guys. Thanks for stopping in. So last week I put out a video or a short asking you guys for your input on what videos you would like to see me create. And I got 3 comments, so thank you guys who contributed. We got 2 that I feel like are closely related, and so I'm going to be covering both of those in this video. So Cryptonomics commented technical analysis, when bottom, sir. So how to find the bottom using technical analysis. And then the one that was closely related was Windmill 63. They said best cryptos to hold in a bear market. So again, thank you guys for your contributions. I'm going to combine those 2 in this video because I think they go well together. And then Gary Turner, I didn't forget about you. Thank you for your contribution as well. So he has Solana Web 3. So I'll put out a separate video, Gary, talking about Solana Web 3 and my thoughts on it later on. So be on the lookout for that one as well. So before we get into the technical analysis piece, for those of you who don't know, there's really 2 major approaches to investments in general that most people tend to use. So you've got your fundamentals, which are things like revenues, teams, cash flows, value propositions, all these sorts of things fall under fundamentals. Then there's the technicals, which is heavily chart related. So looking at a candlestick chart, RSIs, and lots of other indicators. There's tons of technical indicators that people like to use. And there's people that solely use fundamentals, and there's people that solely use technicals, and most people use a combination of the 2. So I myself, and this is kind of how I was taught. So when I was in college, I got an internship at an investment fund, and when I was working there, we approach things by the fundamentals first. So we would look at the fundamentals, determine, this is, and we were dealing with stocks in that case, so this is a good company, they have good revenues. In the crypto space, what I'm looking for is this is a good team, they have a good value proposition, they're unique, their tokenomics are strong. Then once you've determined those fundamentals, you move to the technicals to determine your entry. So from there, I would go, okay, this is a team I want to invest in. I like the project a lot, so I want to buy their token. So next, what I'm going to do is I'm going to go to the chart and plan my entry. So that is how I use technicals. And then I use them again upon exit. So once I feel like the fundamentals have gotten frothy, maybe the company is overvalued or the project's overvalued, or it just never met the value proposition that I expected, I'll then go to the chart to determine my exit. So again, that is how I use it. I'm not 100% like technical traders. There are people who just solely use technicals, and I would say no pro. However, I do have quite a bit of experience with the technical side. So as far as determining the bottom, to answer Cryptonomics' question, I'm going to turn to the Bitcoin chart so we can take a deeper look at that. All right, so I have the Bitcoin daily chart pulled up. First thing you're going to want to make sure that you are using when you go to find a Bitcoin chart is you should probably use the exchange that you trade on mostly as the exchange that you're pulling the chart from. So in this case, I mostly trade on Coinbase just because it's the easiest for me in the US. A lot of people like Binance as well, so that's a good one. You need to just make sure that you're picking a liquid exchange. If the exchange is illiquid, you're not going to get the right price, or it's going to be lagging just because there's not enough volume. So Coinbase is a good one. Binance, Bitstamp, Bitfinex, all of those are fine. Again, I recommend using the one that you use personally to actually do your trades. So, okay, we've got the daily chart pulled up. I'm a firm believer that anything longer than the daily is too long, anything shorter than the daily is too short, unless you're day trading, which I'm not a day trader, so I'm not going to pretend like I can give you guys all the answers there. That's just not my forte. So, when I have the daily pulled up, and when we're determining a bottom, there's a couple things we want to look at. Now, I like to have the RSI pulled up. I know a lot of people like to make fun of the RSI. Technical traders will be like, oh, RSI is so basic, dude. Why are you using the RSI? However, I found it pretty solid in the crypto space. It gives you a good indicator of when things are getting frothy in the market. So for those of you who don't know, what RSI is basically gauges the strength of people's position currently in the market. Okay, so if the RSI is high and you see it spike above the 70 mark, that means a lot of people are in the money on their positions. They're making money, so they're more apt to sell, or they're in a good place to sell, which will put downward pressure on the price. So when you surge above that, usually you get a reset, so you see it trend back down. When you're below this 30 mark, then that means the complete opposite. That means a lot of people aren't necessarily in the money, or they're just now establishing their positions, which is what you want to see, which is where we are right now. So that is one good thing we have going now. Now, the other thing we need to pay attention to, is how Bitcoin reacts in bear markets in the past. So when we're looking at Bitcoin in the past cycles, so we'll use the last 2017 cycle, when we get our top here, we blow off, and then we get sort of like a stair step down. Now, this was a sharp stair step in 2017. So you rise up, and then you get this boop, down, up, down, these little bear market rallies in between here. But it's not until you hit a major accumulation range like we see in like November 18 up to May 19, where things start to kind of turn back around. Now, again, this wasn't a major cycle, so you still had lots of time to accumulate. But if you had accumulated down here, you're doing really well in 19. And again, what you're looking for is a tight range like we see here, and then just a solid bottom forming. So you can see multiple times we tested here, and we're just trading sideways pretty much, which is a good indicator that that's a good time to start accumulating. And then you see this accumulation happening here. So how you can tell people are accumulating is that you get the bottom, so you get the big fall, you trade sideways, and then you just start to see lower highs being built, and you see this curve up to the right. Okay, you see a nice like bowl shape forming, and that's because people are accumulating tokens. So when that's going on, then you have a good indicator that your next cycle is going to start, which you saw a mini one here in 2019, but you really see this curve when we're looking at the last cycle that we just had. You see a nice curve after this long accumulation. You get a nice curve upwards, and all of a sudden, bam, it breaks out. You start the massive cycle that we saw. And again, this curve is going to be your trigger that the next cycle, the next pop is coming. So, once you start seeing that, it's probably a good idea to throw a little bit more money at it here. And then once it really starts to take off, you stop accumulating and you just hold what you've got and you wait. And then again, you start looking for top indicators, which I'm not going to go into those in this video, but what we're looking for now is we don't really have that accumulation range like we saw here and like we saw throughout all of 19 and 20 pretty much. Crypto very rarely V bottoms, guys. Okay, you might have a good trade here like you see in July. It's kind of a V bottom here. It is a V bottom here, but even in March 2020, guys, when we went all the way down to $3,800 in this COVID crash, you had lots of time to accumulate coming out of this. Okay, it took a long time just for it to get back to the level it was at. So if you were buying this whole time, you're in a pretty good spot. And then again, you get that curvature up. There's that curve. That tells us the bear market is ending. People are accumulating, and then you get a breakout. We are not seeing that right now. Okay, so the macro narrative is bad. We don't even have a good macro narrative. And it looks like we are still in our stair step down. So you see this top here, we fall, accumulation range, fall, accumulation range. But the thing with these accumulation ranges is that they're all like angled at a downward slant, which tells us there's just more selling than there is buying. You get little pops out of it. This one was up. It's a little tricky there. But for the most part, they're this like the standard Bitcoin stair step down. So you get the break up a little bit here, falls off, can't hold the rally. None of these are holding, and now there's like no rally. So if you looked at me today and you said you've got to make a decision on where Bitcoin goes, what I'm looking for, so there's a couple levels that I would say are probably going to be the ones to watch. So this is your top in 2019, and then this is our COVID low, as well as where we spent most of the range. Oh, come on, let me set it. Right around 65. You'll probably see some. I highly doubt we ever get this low again, guys. Now, can it happen? Absolutely. This is crypto, man. Welcome to the Wild West. But I doubt it. There's just a lot of money involved right now. I would be willing to put one right here at 10K just because that's such a mental level. But realistically, what I think we see is we probably see us do something like this and down here. Okay, and actually it probably looks more like this. That right there. If you told me that I had to make a decision on where things go today, this is what I would say you probably see. And then we stabilize somewhere around the 14K level. Now 14K again is the 2019 high. The reason we're stopped where we are now and stair stepping is because this was the previous 2017 all-time high. So you had some people defending it, but guys, you're just not seeing the defense, and you can see that in the volume. So every time we form a strong bottom, like we see here in March 2020, you have a big sell candle, but it's followed up real quickly by a huge buy candle. Now, there's lots of buy volume in that candle. You also saw that down here in 2019. So you got some solid buys, these spike, these high volume green wicks or green candles. Again, we're not seeing that right now. We had some sell, a huge sell, but we have not seen, the buy side pick up and exceed the sale pressure so far. My guess is that we have another step to go, and we probably see something like this. And then again, you'll have lots of time. It'll probably stay down here, and then we'll start to see the macro economy turn around, maybe narratives build back up for crypto, and then you'll start to see it the next cycle. You'll get a nice curve out of it. So that is what I'm looking for when determining a bottom. All right, and then getting to Windmill's question. So Windmill has a great question as well, and they ask, what tokens should you hold in a bear market? Now, my answer might seem pretty vanilla on this. And Windmill, my guess is what you're looking for is what altcoins should you hold? Where is there still value in a bear market? Now, I will say cash is king in a bear market, okay? If things in crypto look like they're starting to get really shaky, and like at the beginning of this year when they're really starting a downtrend, and it's an obvious downtrend, cash is going to be your best friend there. And the projects that promise you consistent returns, that promise you that they'll maintain value even in a bear market, those are ones that you should be most skeptical of. So like your Lunas, and I know you're probably thinking, oh my gosh, like, dude, you're saying this only because Luna crashed. I promise you that I would have given you the same answer even before the Luna crash. Algorithmic stablecoins and tokens that have exposure to like really intricate processes behind the scene to prop up value almost always fall apart in a bear market. And the reason for that is because a lot of their treasuries are using volatile assets. So when their treasuries are filled with anything that isn't cash, they are also susceptible to the volatility of a market. Anyone is. And it's not necessarily like, I guess, a fault of the project. It's just the design mechanism is what creates that volatility, which in turn will affect their tokens. So in Luna's case, obviously that's the most drastic end of the spectrum you could get, but their treasury, again, was all backed by crypto for the most part. They had some cash, but then that cash was used to buy Bitcoin, and then when Bitcoin's price tanked, they were forced to sell, which drove the price further. We know that whole story. So you want to avoid tokens that have these, I would say, prop up value propositions. DeFi as a whole gets a little bit risky in a bear market just because you don't know where their money is located. And what I mean by that is they probably have a treasury of some sort, and then they probably have a lot of exposure to whales. So, a project like, and I'll use Curve as an example here. Curve is a great project, don't get me wrong, and they've held up tremendously through the bear market. But these pools are usually supplied by whales. So what happens then if a whale decides to withdraw? Or in Aave's case, when a whale gets liquidated on a massive position, how does that affect the rest of the protocol? Now, again, these are blue chip protocols that have held up very well, but again, we don't know the behind the scenes. It's all interconnected. And so we don't want exposure to that in a bear market. What we want is something that if we're going to hold a token, we want it to be a pretty stinking plain Jane token that has value, but can't be, I guess, racked by contagions like we've seen with like the whole 3AC situation. Because you had big projects, even like these are companies like BlockFi and Celsius that were heavily affected by both Luna and Three Arrows Capital. So again, these are massive, multi-million, I think even billion-dollar companies that were affected by this exposure. And so, if they're affected, then little DeFi protocols are certainly going to be affected as well to some degree in some cases. So you want to limit that exposure. What I'm looking for is strong L1s that I know will bounce back. Okay, so Bitcoin, Ethereum are your two obvious. Those ones are always going to bounce back. I like AVAX, Solana. Now they're going to dump heavily in these bear markets, as we've seen. So this is why cash is still king, because yes, they'll bounce back later, but you still want to buy them. Or you want to have more money to buy them on their lows instead of just riding them down. So again, if you're looking and want you want exposure to the crypto market, you don't want to sit in cash, I think L1s are going to be your best bet, the strong ones. Okay, so the top ones, I would say anything outside of the established L1s with projects building on them. So again, Solana, AVAX, and Ethereum. Once you get outside of that, you got to be a little bit careful because if they don't have projects building on top of them, then they run the risk of not having enough value to keep going, right? There's a chance that the team behind them might go under. Now, we didn't see a lot of that this cycle, I will admit. So, your Nears, these other L1s that were sort of brand new when the bear market came, they held up pretty well as far as the team's cash position. But again, their tokens tanked. Even Solana and AVAX and Ethereum, really, they all tanked. So, again, this is why you want to sit in cash during this time so that way you can buy the dip later. And then use that technical analysis like we pointed out in the chart to determine when to start buying. Again, your goal here is to find tokens that'll bounce back. And you want to avoid small teams because there's small teams. There's a high risk that they're going to run out of money in the bear market. So even if their project is fantastic, even if the idea is there, the value is there, if they don't have enough money to keep going, then you're sort of SOL there. So, and surprisingly, NFTs have held up well too. And this kind of ties back to my simplicity, kind of answering the simplicity question. So because NFTs are super simple, their value is extremely obvious, right? Like their value is the picture, the art itself, maybe the community, and a couple of things that you get out of holding the NFT. These are simple, and they've actually held their value well relative to the L1 token. So a lot of the Ethereum based NFTs have actually gone up in ETH value. Yes, their dollar value has fallen, but they've went up in ETH value. So that's a good way to sort of hedge a position, I think, is if you buy some blue chip NFTs. Now, I know this might go against what some people are thinking. They're like, why would you want to buy art in a crashing market? It's a liquid JPEGs. I get that. But as long as you're not throwing your full stack in this, if you want to buy, if you can afford to buy a couple blue chip NFTs and your goal is to get more Ethereum or something like that, then they have proven to be solid positions for that. Because again, what you can do, buy the blue chip. If the market does tank, the ETH value of these blue chips should climb, and then you can sell the blue chip, get more ETH out of it, and kind of go forward. Now, this isn't all of them. There's some projects that didn't go up in ETH value, and some of the blue chips are ridiculously expensive, so I would never spend that kind of money, like the punks and apes, and some people might disagree with me there, and I totally get that. You're into what you're into there, but the ones that are really expensive, that's a lot of exposure, at least for most of us in our wallets. But again, the tokens and what I would recommend holding is being largely cash positions. So once we determine that we're in a bear market, what you might want to do is take like 75% of your portfolio, put it in cash, take the rest, spread it across L1s. The only exception outside of that, I would say, would be Chainlink. Chainlink has been like, the value is certainly there. The tokenomics are what killed them last cycle, but it seems like we're getting to the tail end of that, so I think that's a good one as well, that you can dollar cost average in. And then once we fall and you have these massive drops, you just want to start dollar cost averaging in until we have a defined bottom, and then you can start putting more and more of your stack in, heavier averages in. So I hope this answered both your guys' questions. If there is a part of this that you feel like wasn't answered, definitely leave the comment down below, and I'll try to address that for you guys. And I want to thank you again for your contributions. If you're new here, definitely like and subscribe, and I will see you guys next time.